Welcome to an in-depth analysis of one of the boldest market predictions this year. Goldman Sachs forecasting the S&P 500 hitting an unprecedented 8,000. We are diving deep into what is driving this staggering optimism. The S&P 500 has been on a tear, but the next frontier demands a closer look at the underlying economic forces. The hook of today's video is simple. Goldman Sachs is signaling a potential 8,000 for the S&P 500. This isn't just a bump. It's a massive, long-term bullish outlook that has the entire financial world talking. We will break down the core rationale behind this 8,000 prediction and, crucially, analyze the great capital shift, why smart money is pulling out of historically safe assets like gold and pouring back into booming stocks. Now, let's explore the fundamental reasons why Goldman Sachs believes the S&P 500 can achieve this extraordinary 8,000 target. Their bullish thesis centers on several key factors. We're talking about robust earnings growth across major sectors, accelerated adoption of artificial intelligence, and continued margin expansion that boosts profitability. Key economic indicators, such as falling inflation and stable employment figures, provide a strong foundation. These metrics suggest a sustainable, accelerated market expansion, moving beyond previous growth cycles. Next, let's look at the tale of two assets: the burgeoning stock market versus the pullback in gold. This divergence is critical to understanding current investor sentiment. Major stock indices like the S&P 500 and the Nasdaq have seen monumental gains. This visualizes the strong momentum driving equity prices higher, attracting significant investor capital. In contrast, gold, often seen as an inflation hedge and safe haven, has experienced recent stagnation or even a slight drop. This pullback is a strong signal of changing risk perceptions in the market. The shift away from gold and into stocks isn't happening by accident. It's the movement of smart money, and we need to understand their motivation. Smart money refers to large institutional players, hedge funds, pension funds, and major asset managers. They are strategic, and their movements often precede broader market trends. Gold's recent pullback is linked to a few factors, mainly easing fears of runaway inflation and a strengthening US dollar. As the need for a hedge diminishes, capital naturally flows to higher growth opportunities in equities. The S&P 8,000 vision isn't broad-based. It's heavily concentrated in specific, high-growth sectors. Let's see where the new capital is landing. The technology sector, particularly firms involved in AI and semiconductors, is the primary engine. Breakthroughs in AI are reshaping industries and promising significant long-term returns, justifying premium valuations. Recent corporate earnings reports overwhelmingly support this optimism. Companies are not just meeting estimates, they are raising future guidance, validating Goldman's projection of robust earnings growth, driving the S&P 8,000 target. No forecast is without risk. While the 8,000 target is exciting, we must address the potential headwinds that could derail this massive rally. Potential geopolitical instability, such as conflicts or trade wars, could introduce severe volatility. Additionally, a resurgence of unexpected inflation could force central banks to become hawkish again, negatively impacting stock valuations. A major concern is overvaluation. As prices climb, the risk of a bubble increases. Investors need to be mindful of whether market enthusiasm is outpacing genuine, sustainable corporate growth. To conclude our analysis, let's summarize the current investment outlook based on Goldman's forecast and the capital shift dynamics. The key drivers for the S&P 500's potential ascent are technological innovation, strong earnings, and a favorable macroeconomic environment that continues to pull capital out of defensive positions. The message from smart money is clear. Risk-on assets are back in favor. While the S&P 8,000 target is ambitious, understanding this capital shift is essential for optimizing your investment strategy going forward. Thanks for watching.